In 2008, the global financial system didn't collapse because of one bad decision. It collapsed because too many people trusted a system they didn't understand. Homes were lost, savings disappeared, jobs vanished almost overnight, and long before it happened, people inside the system knew it was coming. For decades, buying a home had been sold as the safest financial decision an American could make. Home ownership wasn't just encouraged, it was celebrated. Banks, politicians, and lenders all agreed that if more people owned homes, the economy would be stronger. By the early 2000s, interest rates were low, money was cheap, and banks were eager to lend, very eager. Loans that once required stable income, savings, and strong credit histories were now being approved with minimal checks. Sometimes, no checks at all. These were called subprime mortgages, loans given to borrowers who, under older standards, would never have qualified. But the risk didn't scare banks, because the banks weren't planning to keep the loans. Traditionally, a bank would issue a mortgage and hold it for decades. If the borrower failed, the bank lost money. That changed. Instead, mortgages were bundled together and sold as financial products called mortgage-backed securities. Thousands of home loans, good and bad, were mixed together, packaged, and sold to investors around the world. Pension funds, insurance companies, foreign governments. The logic was simple. If one homeowner defaulted, it wouldn't matter. The rest would cover the loss. On paper, it looked safe. Too safe. Rating agencies like Moody's and Standard & Poor's stamped many of these products with their highest ratings. AAA, the same rating given to government bonds. Few investors questioned it. They trusted the labels. Here's the problem no one wanted to say out loud. Many of these loans were designed to fail. Some mortgages started with very low teaser rates that would later spike dramatically. Borrowers were told they could refinance later. But that only worked if housing prices kept rising, and everyone assumed they would. Housing had never fallen nationwide before, at least not in modern memory. That assumption became the foundation of the entire system. Not everyone believed it. Inside banks, some analysts raised concerns. Independent economists warned that housing prices were detached from reality. In 2005, hedge fund manager Michael Burry began betting that the housing market would collapse. He wasn't guessing. He read the actual mortgage contracts. He saw the defaults coming. Others followed. But their warnings didn't slow the system down. Because slowing down meant profits would stop. Banks made money by issuing loans, not by ensuring they were repaid. Mortgage brokers earned commissions per loan, not per successful borrower. Rating agencies were paid by the same banks whose products they rated. No one in the chain was rewarded for caution. Everyone was rewarded for volume, and as long as housing prices kept rising, the system looked healthy, until it didn't. By 2007, defaults began to rise. At first, it seemed manageable. Then, investment firms started reporting losses. By early 2008, entire mortgage-backed products became impossible to price. No one knew what they were worth, because no one knew how many loans inside them were failing. Trust evaporated. Banks stopped lending to each other. And when banks stop trusting banks, the system freezes. In September 2008, Lehman Brothers, one of the largest investment banks in the world, collapsed. It wasn't rescued. The government let it fail. Markets panicked. Within days, the global financial system was on the brink. Stock markets plunged, credit vanished. Businesses that relied on short-term loans suddenly couldn't pay employees. Ordinary people felt it immediately. Millions lost their homes. Retirement accounts were cut in half. Unemployment surged. And yet, many of the institutions that caused the crisis were saved. Governments stepped in with bailouts worth hundreds of billions of dollars. The logic was brutal but simple. If the banks failed, everything else would follow. Executives kept bonuses. Very few went to prison. The system survived. The people paid. The 2008 financial crisis wasn't a natural disaster. It wasn't unpredictable. It wasn't caused by one villain. It happened because risk was hidden, incentives were broken, warnings were ignored, and trust was misplaced. The system didn't fail by accident. It failed because no one was responsible for stopping it. And the most uncomfortable question remains. If it happened once, could it happen again? The 2008 financial crisis wasn't just about money. It was about believing numbers over people, models over reality, short-term gains over long-term consequences. It was a reminder that when systems become too complex to question, they become too dangerous to trust. This wasn't a mystery. This was a warning. And this is what went wrong.